to Season 2, Episode 7 of The Behavioural Investor. My name's Will. It's 6 a.m. here in Doha. We have Ben, my co-host. Ben, what's the time?
It's a lovely day. It's 1 p.m. in sunny Brisbane and not too hot given this time of year.
We have our special guest here today, Jagdeep Mavi from Toronto. What's the time where you are, Jagdeep?
10 p.m., 0 degrees centigrade. It's a nice, it's actually kind of warm for early March night here.
Spoken like a true Canadian, calling 0 degrees warm.
It's all relative. It's all relative.
It'd be a national emergency if it was 0 degrees in Doha. What appealed to us about you, Jagdeep, is just reading your Twitter profile. It says here you're a former quant HF and ETF sales, building the holy grail of investing using ETP, and that you have 13 non-correlated assets and counting.
Sure. When I say HFs, you're very character constrained on Twitter. So, you're using a lot of abbreviations. I find it kind of obnoxious in terms of like using all these abbreviations, but it is what it is. So HF stands for hedge funds. So my background is that I started work in the finance industry by connecting with a group of advisors that were running a purely quantitative strategy using ETFs as the vehicle by which they were expressing views in the market. And so it was kind of like a global macro quantitative strategy. I linked up with them, and from that beginning, they eventually launched their own hedge fund and asset management firm. And I went along with them in that process of building out that firm. From there, I moved on to ETF company, main ones here in Canada, the only one actually that does leveraged ETFs and all that stuff. And so from there, I ended up basically going back to school. I hadn't finished off an undergrad business degree from years and years and years ago. And I was a recent father. My son now is almost 3. And I just decided that I didn't want to be a parent that was a university dropout. And so I decided I wanted to go back, finish that off, and move away from my role had been sales. Business development is what we call it, fancy name for sales. After seeing all these different portfolios that advisors and asset allocators were building, understanding that there's this kind of blindness that people have in terms of there's been this revolution basically over the last 20 years in terms of the ETFs coming of age and becoming this force within finance. And along with that, the lowering of trading costs. These can be incredibly powerful tools, and they're just being, in my opinion, underutilized, especially the ones that are kind of these hidden gems beyond just the stock and bond type of vanilla ETFs that can be used to express views and gain exposure to asset classes and strategies that previously had only been the domain of like the most elite institutional investors. We've now achieved a level of innovation in finance where they have trickled down to a level where someone with a Robinhood account can go log on and put this in their portfolio and build something literally that's world class in terms of the risk adjusted returns that are achievable, and right up there with the best hedge funds in the world, and do it all at very low cost, and also more importantly be completely accessible even with a portfolio of, let's say, a couple $1,000s. That's actually kind of mind-boggling when you think about it in terms of the level that all of this has progressed now, and the way that investors can now express views on markets all over the world. And even for me, it's still kind of like staggering when I really sit down and think about it and look at what are the things that are available to us as retail investors. So that's how I'm approaching things. I myself have been managing my family's money for years, made a lot of mistakes, and we can get into all of that. I actually earlier today was listening to your season 2, episode 1. I think it was Will Gets Put to Work or whatever it was. And I thought that was your best podcast yet out of all the ones that I heard. I loved it because, that's
my most honest one.
Right. But you guys hit the nail on the head for a lot of different things. And I totally found myself nodding in agreement. So, and I think that's how it works. If you want to be a good investor, you have to take your lumps, you have to pay your tuition. And that tuition is always going to be going through some type of very painful experience. that's the forge that kind of like, you know, you get burned alive in, and out of it comes this person that has learned something and is wiser. So you obviously had that journey with Bitcoin. For me, it was investing in the tech bubble back in 2000. And I was investing my parents' portfolio, and that was, you know, a lot of lessons learned, and very much informed my investing life after that, in terms of subsequent to that, my journey and how I think about building portfolios and investing money. Rule number one is don't get destroyed, you know, and I think that's the thing that most people are, especially if they're new to investing, and they're new to investing particularly in this point in time where we are in the market cycle, where we are in the debt cycle. It's easy to get sucked in to the things that are shiny, the things that have gone up a lot, but there will come a point at which you have to pay that tuition. And I think there's a lot of people that they haven't experienced that yet, and they will.
Yeah, I think it's great timing actually that we've found you, because I reckon in the past few days, there's been a few people who've paid the learning tax. And you brought up the popularity of ETFs and the term shiny. I think that applies to the collection of ARK ETFs managed by Cathie Wood, which have all started to return to earth.
Right. And I, you know, nothing against ARK. It seems to be like a favorite pinata right now for FinTwit to bash on ARK and all of that. What they've done in terms of gathering assets is incredible, right? And I've been on the other end of that in terms of like, you know, trying to gather assets into a product. And you know, their success is really just remarkable in that regard, and all of that. But you know, beyond ARK, I think it's more in general this idea that stonks always go up, and you know, this is the narrative that pervades right now, because a lot of these people that are coming into investing today are, you know, I guess not even millennials, they're Gen Z for us Canadians, Gen Z for everybody else, I guess, but they don't
say Z too.
I'm sorry.
Australians are civilized. We say Z as well.
Oh, do you? Yeah, you guys speak the Queen's English. That's right.
Yes.
So it's one of those things where, you know, I went through that as a 20-year-old, you know, back in 2000. And at that time, you know, the narrative was there's the old economy and there's the new economy, right? And everything was going to be eaten alive by the dot-coms of the world. We don't need to worry about commodities. Like, how barbaric is it that there's a company that's pulling metal out of the ground and you know, cutting down trees and hewing oil and stuff. So we didn't need it. We didn't need commodity stocks anymore. We don't need, you know, banks. We don't need manufacturing anymore. None of that matters. All that matters is bits and bytes. I lived through that. And in fact, here in Canada, you know, 40% of the TSX at one point became Nortel. And Nortel was one of the major networking stocks. It was our version of Cisco, you know, up in the north. And if you can imagine that, you know, even if you're an index investor, 40 cents of every dollar you were putting into the index was tied to this one company. And if you look at what happened to somebody that was in Finland, I think at some point Nokia was like 70% of their index, right? That's how big the tech bubble was at that time.
I didn't realize that. That's incredible. I wonder what the Australian equivalent was.
I have no idea. You'd have to go back and look. But so you know, it sucked everybody into this, right? Like, even if you were just an index investor, you got sucked into it. But even worse, you know, I was like, oh, forget about the old economy. We need to be, you know, going into NASDAQ 100. That's what we want to own. And the NASDAQ 100, you know, peaked in basically March of 2000. And subsequently went on to lose 80% of its value over the next 3 years or so. And it took about 14 years to get back to even if you bought at the peak. And that's right around, like, I bought a significant portion of NASDAQ 100, the triple Qs for my parents and their portfolio. That would have been probably around January of 2000. Right. So for 3 months we were happy, and then, you know, everything started to fall, and eventually it took a while for the S&P to kind of it was lagging behind that sort of initial tech bubble bursting. But the S&P had its pain as well. It took something, I think it was something like 12 years, 10 years. Like, it was a lost decade for the S&P 500 as well, because it was a tech bubble. You had 9/11, you had the Iraq War, then everything recovered, and the Federal Reserve had basically brought down interest rates to keep the economy from imploding after the tech bubble and 9/11. But that created a new bubble, which was the housing bubble, right? And then eventually the housing bubble burst, and you had the global financial crisis. You basically had a full 10, if not more, years where, as an investor, you were completely flat during that period of time. So I think that kind of pain, a lot of investors haven't invested through that. And so until you experience that, you don't learn to kind of understand risk and what risk really is. And losing 80% of your money and waiting 14 years to get back to even is painful. And so that's why you want to have a portfolio that's diversified beyond just stocks. Obviously, bonds are a good place, but bonds are also not a place of safety right now because of what's happened in terms of the quantitative easing, printing of money, near zero, if not negative, real interest rates. There's 20 trillion of global debt right now that is negatively yielding. And some of that is even corporate, or in fact, big chunks of that is corporate debt. That's staggering when you think about that. So, that's why bonds right now aren't necessarily they're normally the safety valve for your portfolio. And I think, my sort of thesis and what I sort of try to explain to people is that you need to have further diversification. You need to have other assets in your portfolio beyond just stocks and bonds, so that it protects you in the case that bonds don't do what they're supposed to do traditionally.
Put another way, possibly bonds will go through a period of volatility just like stocks, and therefore, in seeking to minimize volatility, perhaps one could turn to other non-correlated assets.
Right, exactly. And I was just like taking a look at some of the historical returns for like a 60/40 portfolio, and on an inflation adjusted basis, on a real return basis, the real pain point in the 20th century was actually 1966 to 1981. And on a real return basis, you annualized at a negative 36 basis points per year for that 16-year period. And what's fascinating to me is that, like, I saw somebody tweeting about this, and that's what I was kind of confirming, is that if you retired in 1929, you actually would have been okay, even with a 60/40 portfolio. You didn't run out of money. You would have been fine. The real pain point comes in 1966. If you retired then, you would have basically run out of money after like 15 years, depending on how much money you had and how much you're withdrawing. But if at any point during your retirement, you hit that 16, 17-year window, you're screwed. You're done.
Wait, is this, I'm just looking at the chart. So I've got 66, I'm in trading view, and I'm 66 to 74. It went down. So it was lower in 74 than 66. Is that sort of what you're saying?
Well, I'm saying, but more importantly, you have to adjust for inflation during this period of time. So on a real return basis, bonds got destroyed, right?
Yeah.
And they correlated with stocks in a positive way. They also did this in the 90s, but nobody noticed or cared because both stocks and bonds were going up, right? But when stocks and bonds go down together, it's not a good time, especially if you're doing a 60/40 portfolio. And I think my issue is with this, what I would call this recency bias, in the sense that since 1982, if you look back in time, 60/40 looks fantastic, right? It's the place to be. And is it any wonder that if I go to basically any bank in Canada and look at any kind of average Canadians or Americans portfolios, almost 90% of the people out there have a 60/40 portfolio. And that makes sense because it's done well over that significant period of time. But that doesn't mean it's always going to do well. And you can run into this, like I said, this window where, like, from 66 to 81, that portfolio, if you're a retiree, you're done. Like, you're going to be eating cat food at the end of that. So that's the concern that people should have, is that is this thing built robustly enough to withstand a period of time that's out of sample in terms of, this window that everyone seems to be looking back at. And I think the regulators also play a role in this. I've seen this where, the what blew my mind was that at the ETF company I was working at, we got this memo where suddenly all these equity ETFs that we have went from high risk to medium risk. And it made no sense to me. I'm like, well, so what happened here? And they're like, well, because there's a rolling window look back that they do, the regulator does. So over 10-year window, they're going to look at what the volatility and all of that was. And this was 2018. So what happened 10 years ago, 2008? And so that has fallen off the window. And now suddenly these products go from being high risk to medium risk. And that actually means something, because now the advisors that are putting these into client portfolios, they can put more equities in their models according to the banks and according to the regulators, internal control systems, without any kind of repercussions. Like, that's totally fine, right? But it just blew my mind, because we know what happened in 2008. That history isn't suddenly erased. It just went off the model that the regulator is using to model risk. And so, that's the type of thing that I think can make people very vulnerable, is thinking that like the regulator has their back, or that their advisor has their back, or that the bank does.
That sounds literally short-sighted.
Yes. And it's just like, that's nuts. And so I think you really want to think like an engineer in terms of, if you're building a bridge, right, you're looking back over the last 100 years, 200 years, what's the worst storm? What's the worst earthquake? Those are the types of metrics that they're looking at to build something like the Golden Gate Bridge or something equivalent. And, the idea that we would truncate our look back to the last 30 years because that's what's most convenient, or whatever the reasoning is. I don't know why they do that. Just is kind of just mind-boggling to me. And in fact, the worst thing is to always be trying to drive looking in the rearview mirror, right? What we want to be thinking about, if we take that bridge analogy, is that the world has changed over the last century. We have global warming now, and weather is probably going to get more extreme, not less extreme, going forward. So whatever that 200-year or 100-year storm is, if you really want to be conservative, you should be doubling whatever that sort of, storm looked like, whatever the high water mark was, right? How high was the flooding? How strong was the earthquake? You want that margin of safety, right? In terms of like, how bad can things actually get? And what does it look like in terms of how does that play out to my portfolio, or to the bridge that I'm constructing? So, and you won't know the difference between someone that has built a bridge to that specification versus one that's been built to the sort of normal specification until that event happens. And I think that's the really interesting thing, is that you have no idea looking at that portfolio until it hits that point of turbulence and real test. You will have no idea the difference between that portfolio versus the one that seems to be robust, or you're told is robust. So yeah, I think those are important concepts, is that we have to be truly structurally diversified, not just superficially. Owning 1,000 different stocks and owning 1,000 different bonds is not true diversification. So you need to have something that is structurally and fundamentally inversely correlated with some of the other assets that you have. So I think a great example of that, it's something that's stood the test of time as a non-correlated asset to stocks and bonds, and to me is one of the main pillars, is gold, right? And I know everybody has their opinions on gold, and some people hate it, some people love it. I don't care. I'm not a gold bug. I'm not a gold bear. But when I look at the numbers, if I put that in as an asset, and it doesn't have to be a lot, you could put 10% in, that's enough to help, basically save you during a period like the 1970s. Or more importantly, it's just this thing that's non-correlated. And so that's sort of my mantra. If you go to my Twitter profile, I have a video there linked, and it's to Ray Dalio talking about putting together non-correlated assets. And, that's sort of my guiding principle in terms of how I approach things, is, the thing that goes in has to provide some type of benefit. And it doesn't necessarily have to boost returns. It just has to make the portfolio more robust and more diversified. That's what I care about.
Just on that topic, I mean, you started the conversation talking about the diversity of ETFs that are available, and that most investors at the moment do the 60-40 between equities and bonds. What other products are there? And you've touched on gold. What else is out there? And as soon as you said gold, I suddenly thought Bitcoin. So maybe comment on that as well, and whether you see that as being too speculative, or at the right percentage, it's okay in a broad portfolio.
Right. Yeah, no, I think Bitcoin, absolutely. You can put that in a portfolio. I literally think you can put almost anything in a portfolio as long as you bet size it correctly. So, what I try to look at is through the lens of volatility contribution, right? So you literally, when I look at my portfolio, I would add, I think somewhere between 1 to 5% is kind of the range that most portfolios would be able to accommodate Bitcoin as an asset. And again, I don't have a horse in this race in the sense that like I'm a Bitcoin truther or anything like that. I look at it, and it's an asset that's very uncorrelated. Now, again, that's looking backwards in time. Going forward, when we talk about what Bitcoin's going to look like, assuming that it doesn't turn out to be just, magic beans and goes to zero, it's likely going to be, and this is my view, is that I think that Bitcoin is going to be increasingly adopted by institutions because they're all chomping at the bit to be able to like add this thing. And again, from a portfolio management perspective, when I look at this thing, it's extremely high volatility. I know that the general sort of consensus is that high volatility is bad. It's actually the opposite. You want super high volatile assets because that means that you'd only have to put a little bit of money in them for them to make a big difference in your portfolio, right? So Bitcoin checks that box in spades, right? Its standard deviation is like 150% a year. And so that's great because that means you only need to put 1% of your portfolio in it. And that's enough to give you the exposure that you'd be looking for in terms of like a diversifier and something that is like very convex. It's like a lottery ticket, right? So you put this one percent of your portfolio in, and it could be this huge hedge against if central banks totally screw everything up, or if every single major asset manager ends up putting an allocation into this, it goes to the moon, right? So I do believe that the long-term adoption of it is going to happen. Is it specifically Bitcoin? Sure, maybe, or maybe more broadly, it's crypto, right? Again, I'm agnostic to that. I think, if you can buy that plus Ethereum plus a bunch of other things, great, do it. The point is keep that to a sleeve in your portfolio that makes sense from a volatility contribution perspective. And that again comes back down to bet sizing. So you can put super risky assets in your portfolio as long as it's something that is balanced against a framework of other assets you're putting in there that are helping to sort of smooth out the volatility. I'm not a huge, we've sort of discussed this prior. I don't think volatility is the only measure of risk that one should pay attention to. The way that I kind of explain it is that volatility is like turbulence on an airplane, right? It's scary. It's very salient. You feel it, and it's not fun for the passengers or anyone that's on the plane. But it's not necessarily the key risk that's going to cause a plane to go down, right? And it's also part and parcel. Like as soon as you get on an airplane, you accept the fact that there's going to be some turbulence on it. Anyone that's ridden around on airplanes knows that. So that's something that kind of going in, we kind of have to accept, right? To a certain degree, there's going to be some turbulence. And if I was to build an airplane that was optimized to just minimize turbulence, probably what would happen is I would actually end up making that plane less safe because I would actually end up decreasing its operating envelope because it'd be more heavy and it would have this rigidity that airplanes don't necessarily have. Because the bigger risk is actually things like, did the pilot get enough sleep, the night before? Did the co-pilot have enough hours in the cockpit, with professionals around them, learning to communicate with one another? Did the guy that, went through the checklist in terms of the, checking all the parts on the airplane, was it a Friday afternoon, and was he trying to get out of the hangar as soon as possible?
Great to bring back the airline and flying theme from earlier.
So to me, those are they're not salient risks, but those are the things that are actually the ones that matter in terms of whether or not I'm going to blow up over the Atlantic Ocean or not. The salience or the very visceral experience of turbulence, I get it. I'm not saying that that's not a risk and that's not something that's scary to people, but it's not the most important risk, right? And I can give you another.
I thought you wouldn't want to run the risk of mistaking taking off at all in the plane for volatility or turbulence.
Right, in the sense that, like you're getting on a flight, you're taking off, and that experience of thrust and all of that is part of the whole thing, right? And so you actually raise a good point. And so this is my kind of problem with standard deviation as a measure of risk, is that it's symmetrical. So when your portfolio's like really taking off, you're actually getting penalized for that, right? But if we take an asymmetric measure of risk like Sortino, so now we're just looking at downside volatility. And I think that is a better expression of understanding risk, because that's the risk that I care about. It's suddenly hitting an air pocket and the plane falls by 1,000 feet. That's scary, right? And that's something I want to avoid as much as possible. And people could get injured in a situation like that. So the way that we think about a lot of these things, I think there's this sort of simplified heuristics that we're given in terms of, don't use leverage, don't put super risky assets in your portfolio. You should be avoiding volatility and high vol assets. I think some of those things are rules of thumb that aren't necessarily true. And so we have to kind of evaluate them on a more case by case basis and understand that there's different ways we can put together portfolios, and there's different ways we can harness some of these things. We can actually make volatility our friend, because you can do something called volatility pumping. As I rebalance the portfolio, if I have something that's gone way up and something else that's gone way down, as I rebalance, I actually get to arbitrage the difference between these two things. Every time I rebalance is an opportunity for me to basically buy low and sell high. And the higher the volatility, the greater the range is between those two different potential assets at a given point in time. And so ideally, if I have a whole basket of these things and a bunch of them are, not correlated with one another, I have more and more opportunities to do this.
You mentioned the first episode of season 1 and the crucible that I went through, but you just mentioned the term leverage there, and that reminded me of a crucible that Ben described going through also in the same episode. Ben, could you just remind us of what that crucible felt like for you? Because I think this sets up an interesting discussion, and that was also part of the appeal for having this interview for me, because in our discussions on Twitter, Jagdeep, you also mentioned the use of leverage, but there was significant consequences for Ben in the past using that. So I think that might be something interesting to explore. But also, it's great just hearing you talk, Jagdeep. I'm writing down a lot of the terms you're using, and I think Ben and I might like to get some definitions for some of those as well. Ben, could you briefly describe maybe what it was like using leverage in the way you chose to? And I think it might be interesting to discuss or hear what Jagdeep has to say.
Obviously, leverage amplifies the impact of a downward cycle on your investments. And at that time, I'd taken out margin loans, and it was just around the time of the global financial crisis where stocks started to plummet in October. It just amplified. Asked, how did it feel? It's quite obvious it didn't feel too good.
Jagdeep, you have a belief that it's possible to responsibly use leverage.
So I can imagine that was a super painful experience, being leveraged going into basically the worst time for equity markets since the Great Depression is not a fun experience. So I empathize with you a great deal. That must have been awful. But despite that, I would say it's a tool. It matters what kind of leverage, and it matters what you're leveraging. So in your instance, you're talking about recourse leverage, right? And I'm not necessarily an advocate for that. you want to have what we call non-recourse leverage, meaning that the most you can lose is whatever you put in, nothing above that. And the beauty of leveraged ETFs is that they give you that, right? So they're using futures as the underlying sort of vehicle, not always strictly futures. There's derivatives contracts there. So it's whether it's futures, whether it's swaps, there might even be some options involved. The nature of futures, the nature of swaps, the nature of options. Swaps, it depends on the structure of the contract, but with futures and options at the very least, you have embedded leverage, right? It's built as part of how those structures work. And so that makes leverage very, very cheap within those constructs. And those vehicles, like, so with options, depending on how you do it, like for example, the big innovation that all the guys on, or all the people on Wall Street Bets have discovered is Yolo Calls, right? And that means that you're buying deep out of the money calls on a given underlying. And it's like a lotto ticket effect, right? It's basically you're putting in a very small bet size in terms of, like, it might be $1,000 they're putting into this. But if it ends up going your way in terms of within the time frame that you've set up that bet, let's say over the next 3 months, I expect GameStop to go up, 50% or whatever it is, then that pays out in a very exponential function of that underlying, because it's highly convex, right?
So what is an out of the money call? How is that non-recourse leverage?
So in the sense that if I buy an option, right, not writing an option or selling an option is a totally different thing. And so now you are exposed to recourse in the sense that you're on the hook, right, for whatever it is that you've promised to do through the options contract. So to keep it simple, we're just talking about buying something. So you're buying a call, right? And a call basically says that I have the right to buy something in the future at X price. And the purchase of that call, it entails a premium, and you're paying that premium, and that's your max loss, right? So if that premium I paid $10, whatever it is, that's all I can lose, right? But that has tremendous embedded leverage in it, because it's, again, like, it's this very convex function of whatever is going on with the underlying. And the more and more that the future price ends up being closer to whatever my strike is, what they call the delta and the gamma functions change, because options are non-linear contracts, right? So the options get into some weirdness. So they're because of this non-linear function of them. And by the way, bond convexity works the same way. The longer your duration, the more convexity you have in the bond. And so what happens is as prices are moving, they have bigger and bigger effects, right? As they get closer and closer to these edges of this convexity, basically. So they can be profoundly powerful tools, but you have to understand what you're doing, right? And so again, that's an example of leverage. Now, to reel it back in.
Hang on, we've solved your problem, Ben. So you need to go on Wall Street Bets and buy deep out of the money calls.
And that's a way to express.
You weren't a degenerate Wall Street Bets trader. That's the problem. You're too responsible and being a.
So, but there is somewhere in between we can go, and so in between would be that you can go buy a levered, S&P 500 fund, right? And you can get that at 2 times leverage or 3 times leverage. And what they're using is a combination of futures contracts and swaps to basically give you levered exposure to the underlying index. And the beauty of that, again, is all you can lose is the amount of money you put into the ETF. So if I buy $100 worth of that ETF, it could go up a lot, it could go down a lot, but it can't go below 0, right? Now, if you really want to get crazy, you could buy that on margin, and now that's a different thing. Now you've created recourse leverage. But non-recourse is what you want to use if you're using leverage. And
the Wall Street Bets traders are not total morons then?
No, in fact, some of them are really, really bright people that really understand options quite deeply. I'm not, and full disclosure, I'm not an options guy. I'm not deep into, like, you can go on FinTwit and follow all these people who are like, super options, volatility traders and this and that. Half the time I have no idea what they're talking about. But the point is that, you know, there are these vehicles in which leverage is part of the deal. It's just like, you know, if you go buy a house, leverage is part of the deal. You know, most people are not walking into a bank, or you don't even need to walk into a bank. You're just walking up to a realtor and handing them a bag of money and saying, I have cash to pay for this entire house. What happens is that you understand that you're going to put a portion down and the rest is going to be financed by the bank. And the thing is that because the underlying in terms of real estate tends to be a very stable asset, we don't get too freaked out about that, because, you know, and that's why the bank doesn't get freaked out either. You know, they feel comfortable lending against that. And I know Australia's housing market is just as crazy as Canada's. And you know, people here don't bat an eye at putting down 5% on $1 million home and leveraging themselves up 20 to 1. Sorry, go ahead.
It's an interesting point that you just said. You realize that the Australian housing market is just as crazy as the Canadians. But what makes you say it's crazy other than possibly low yield returns and low growth? If I'm reading Sapiens at the moment, and one of the key things that he says in that is humans are storytelling animals. You know, we have common beliefs, common stories amongst us. And if the common story is that house prices are, you know, you leverage them 95%, as you say, and they should be expensive and they're more than just an investment, then and I don't want to try and catch you in a word where you've just said crazy, but I do think it's interesting around humans being story animals and having common beliefs, and wondering whether that plays into your investments as well, and the idea of narrative in purchasing investments. And could you talk a little bit about that as well?
I agree with you that there is definitely a narrative around something as emotional as real estate, as a purchase, right? Because we're not just talking about it as a financial asset. It's a place you live, right? And so I think that there is this qualia to that in terms of it's not just simply trading a piece of paper. You know, it's something that you walk into a home and you experience its ambiance, and so people, and you know, believe me, I've I've looked at buying real estate here in Toronto for a couple of decades. I'm still a renter, and my preference would to be not a renter. I would rather own something, but you know, at the same time, it's very, very difficult for both myself and my wife. She's very risk averse, to justify taking every single penny that we have in terms of our life savings and pouring it all into one asset. And I think a great example of the sort of risk in that is that, you know, looking at what's happened post coronavirus in terms of now people, I live, you know, in the city proper in Toronto, by High Park. It's a beautiful neighborhood here. It's highly desirable from a real estate perspective, but the houses are just, you know, astronomically expensive. I live in a high-rise building that's right by these beautiful homes, and you know, there's not a single house on this street that I could buy for less than, I would say, probably 1.5 million Canadian. And you know, when you compare that to the average person's salary here in Canada, most people are making, you know, around $80,000 a year. That's a lot of money relative to the income that they're making. And when you look at the real income growth versus the cost of housing, it's, the two are very, very disconnected. And
you're talking about the same predicament as the average Sydney sider.
Right.
I also got a job in Sydney, but I decided to go to Doha instead. And it's mainly because of the issue you're talking about. Like, I would have been on a relatively decent salary, but here in Doha, there's no tax. And the cost of living is something like 30% less than in Sydney, which includes the cost of accommodation. I think it's hilarious, actually, property investing, especially in a place like Sydney or Toronto, where you pay more than $1 million and you get objectively an awful house, you know?
Right. Yes, yeah. And that was part of it too, right? Like, pulling the trigger, like we looked at buying a house for, it was, and this was a deal that we were getting through our real estate agent, where like it was something that hadn't even hit the market in terms of an actual listing. And I think they were asking 700,000. And then we'd still, our projection was we'd probably put another 150, maybe 200,000, or sorry, it was like 750. And then it was like going to be another 150 or 200,000 that we would put into it to make it really nice. Cause you're right. It was like a dump, right? And like looking back on it, it still would have been a good investment because this market keeps going up. But at the same time, what I was about to say before is just that this coronavirus thing has also hopefully caused people to think a little bit more about how deeply entrenched they need to be in a given geographic location. Because what we're seeing now is flight in terms of people that were in these very, very cramped downtown condos. They're leaving in droves out to outer areas where there's more space because now they're working from home, right? And these things, like, who could have predicted that, right? Like, a year and a half ago, who would have been predicting that our condo market in the downtown core was going to take this huge dip? And instead you've got people migrating out to the suburbs. That has not been the narrative here in Toronto. I know that's more in the States and stuff. Our cities are not as ghettoized as the US is, and so we have great quality of life across a lot of different areas here. So people want to be in the downtown core. That's like where all the jobs are and all of that. So the idea that would all kind of come apart so quickly is not something anyone would predict. And so, I think it goes back to this idea, and I kind of jotted this down for myself, is the idea that like diversification is the hedge against our own ignorance about the future and just everything, right? And the thing that I think also people lose sight of is this idea that they're looking for gurus. They're looking for people who have this sort of insight or ability to predict the future. I got news for you. There's a researcher out there that did the work on this, Philip Tetlock, and he did a systematic study of people making predictions. And the biggest takeaway from what he learned is that there are no outliers. There is nobody out there that is consistently able to predict the future. That shouldn't come as any kind of a revelation to any human being. We all know that, right? But the amazing thing to me is that when you don't know about something, the first thing we do is we go to an expert and we ask them, to predict the future. And it just, like, none of that makes sense. Nobody knows. And in fact, the weird thing is that the more expert someone is, the more likely they are to actually be wrong in their predictions, because they have this kind of narrow view in a lot of ways. And so I think that when we accept the fact that nobody knows the future, then we can kind of let go of that and start to get to the real business of how do I construct something that can tolerate whatever may come. And I think
that's a good point to I think get on to your list of 13 uncorrelated assets, because I think for the average investor or the average person trying to get a bit of extra money in their lives, they view the property market as always going up. Mm-hmm. I think, yes, there was a financial crisis, property prices did crash, but overall for the average mum and pop uneducated investor, they think it is safe to plow the majority of their money into a house. And Ben, I don't want to speak for you or to focus unnecessarily on the particular crucible that you went through, but I think, it's still useful for everyone to hear about it and to hear an honest discussion about. It's my suspicion, because I know that you have a number of property investments, that maybe you saw the behavioural and the emotional impacts of losing that money on margin, or because of trading on margin. And as a result, you chose the path of financial independence, focusing on property investing, simply because stocks are much more liquid. So when you suffer emotional impacts from volatility, it's easier to exit the market. Whereas when you've got a property, it takes a while to sell one usually.
I just want to say I'm not against property. Like, I think actually the whole reason why property works as an investment is exactly what we were talking about in terms of leverage. The easiest asset you can you can go get leverage on, right, for the average person is real estate. Like I said, the whole system is built that way. So it makes all the sense in the world that when you talk to most average people, how did they become super wealthy? It was through real estate. But
what I'm sneaking up on here is to try to get Ben, the chartered accountant, to go in the direction of deep out of the money calls. I want that.
Set up already a eToro account, and I don't know if they have eToro in North America, but it's sort of like the European app that's similar to the Robinhood one in America. Do have that, and it's somewhat seductive. I've only bought, I was going to buy one share of GameStop just the other day, and it was at $50. And then I saw that a few days later it went to something like 180. So thanks, I'm on that journey, Will, and thank you for steering us into that direction. My financials.
Will is the gambler. He's trying to get everybody into crypto, into YOLO bets.
There's another crucible coming up. I can feel it.
Sorry, didn't mean to.
I want to take us back to that original question, though, around not just those 13 uncorrelated asset types that you've identified, but also could you take us a step back and talk about how the approach that you went in developing up your portfolio, the mechanics of it? Because if someone else wants to do that, I think they want to be a little bit more informed rather than just have a procedure, I guess, or some sort of roadmap on how to look at and think about the portfolio. And it may not be that you've got that laid out in front of you that you can easily talk about, or maybe it is, but you could also direct us in terms of books that might be useful for people to read.
Yeah, I'm not big, honestly, book guy, to be honest. Yeah, I don't read a lot of books. I tend to read blogs, and I'll read some academic papers, white papers, that type of thing. I find I just don't have the patience to kind of wade through 200-page book where there's probably usually 50 pages of it that is the real meat. And so I try to, for me, I'm time is at a premium. And so I try to focus on getting information that I need specific to the thing that I'm trying to do. And so, yeah, there's all sorts of blogs that I follow. There's plenty of people on FinTwit. Like I probably follow 900 some odd handles on FinTwit, which is a terrific place to learn and do some deep dives on some very esoteric things, and also generate ideas. And so in terms of like sort of my process, I've been around ETFs for a very long time. I originally, most people don't know this, but actually, here in Canada, we were the ones that were the first to ever list an ETF of any sort. So they were called index participation units back then. So the original idea came from some people in Chicago. I'm not exactly sure their background, but it was some Americans, and it was, the idea was to basically go compete against the Vanguard index fund. But John Bogle is the father of indexing in the sense of actually taking the academic research and putting that into an investable product, right? And they did that back in 1976. So then eventually this idea came of wanting to create, and to my understanding, it was partly in response to what happened in 1987. In 1987, you had a lot of institutions that were doing what they call program trading through index futures, trying to hedge their positions on the S&P 500. And what they found was that, that system kind of blew up a little bit in terms of creating all this volatility that they weren't necessarily prepared for. So ETFs were kind of this idea that if we could create this exchange traded thing that allows them to be able to express a view on the whole S&P 500, it might sort of be a release valve. So that idea was pitched to the American regulators. They didn't go for it. I think that was all the way back in like 1989, 1990. They came up to Toronto, and, to the credit of Canadian regulators, we're a smaller capital market. They're willing to take more risks. And so they said, sure, why not? Let's do it. So they listed these index participation units, and basically it was TIPS and HIPS. And I think one was the top 35 stocks and the other one was the top 100 stocks in terms of market cap on the index. And those started trading around 1990, 1991, and they were managed directly by the TSX exchange itself. So there was no third-party index provider. There was no third-party ETF company. It was just the exchange itself doing it. And they were dirt cheap. They were doing it at, I think, at 5 bips is what the cost was for this. And I remember I got into investing by the age of 15, 16. And the thing that kind of captured my imagination, and so I kind of relate to you guys in terms of your enthusiasm around the compounding, is I remember seeing a mountain chart, is what they call it, of somebody that invested in the Franklin Templeton Growth Fund back in 1954, and then seeing what that grew to by 1995. And it was astronomical, right? In terms of the returns and what this amount goes from 10,000 to like $1.5 million. And I was blown away by that. And I was like, how is that even possible? And then I started, opening up an Excel sheet and started doing the compounding calculations. And it just started to get familiar with the power of compounding. Like, as I change this number, what does this end number look like by the time I'm 65? And it's staggering, right? When you start to really get that in your head, it is really just incredible learning about exponential growth. And then from there, my father had been investing, and this is back in, he started in the 80s with a broker, full serve broker, and somebody you'd call up on the phone and they charge you like a $300 commission to buy or sell a stock. And their job was to get you to trade, right? And so he had a guy that was pressuring him to trade all the time. So eventually he went from there to, and his sort of path as an investor really maps onto exactly what most Canadians through this era went through. You went from a stockbroker in the 80s to somebody that was selling you mutual funds in the 90s. And then you went from mutual funds to eventually, hopefully by now, ETFs. I kind of helped steer him into ETFs much earlier because I was looking at these things on the stock tables, and I remember getting the newspaper and getting stock tables published, right? And seeing on there these tips and hips, and I was like, what is this? And you look into it, and it's like, in one stock, I can own the 35 biggest or 100 biggest companies on the TSX. This is brilliant. Like, why wouldn't you do this, right? And so it was a little bit later that we got into using ETFs as kind of a cornerstone in their portfolio. And like I said, I made mistakes. I got caught up in the tech bubble, looking at the NASDAQ and the S&P 500 and all this stuff. And so we went, heavier towards tech at that time, bought Nortel, did all that nonsense and lost a lot of money. Now, the key thing I also learned was that along the way, Nortel, by the way, went to zero. So this was the biggest stock on the exchange, 40% of the index, and it eventually went to zero, okay? And whereas any of the index funds we owned, they went down a lot, don't get me wrong, but they still didn't go to zero. They're still here. And that was the big learning experience for me, was that if you buy the index, it'll never go to zero. It doesn't matter.
So the reason you're mentioning that is what you said at the beginning of the interview, where a big challenge or an important thing that investors must do is what Warren Buffett says. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Right. So, and the other analogy I use about investing, it's like going to war. Your first rule, if you're a soldier going off to war, is to come home alive, right? That's your job. More than anything else. You don't worry about winning medals. Don't worry about being a hero. Your job is to get home. And so,
you can stand back up again from your wounds. Yeah.
Right. Exactly. So as long as we don't blow up, then we're good. And so and even blowing up, like in the sense of, I give the example of the NASDAQ, and I totally relate to exactly what you were describing, Will, in terms of your experience with Bitcoin, where, you had this horrible experience with it and you didn't even want to think about it. You didn't want to look at the price of Bitcoin or what happened and all of that. That is a normal human response, right? And that was exactly me. I did not want to allocate new funds. We kind of let cash build up. And in retrospect, that was the big mistake. If you're going through hell, keep going. And that is the other lesson that I really learned, is that if I'd kept kind of dollar cost averaging into the NASDAQ, during that very, very painful period, you still would have been a-okay. Eventually, you would go back to annualizing by now at like 16% a year over that whole period of time, even if you bought at the peak, right? And so I think
and
these
I
are
would have $250,000 in
right.
Bitcoin.
Yeah, yeah,
That's the
right.
most painful thing.
No, I think Bitcoin's a little bit different. I like, because it still could have turned out to be magic beans, right? Like there's no, I think that's a higher risk bet, and so you've got to get the bet sizing right. But if you're talking about, like, even for somebody today, if they're going deep into the FANG stocks and all of this stuff, I think that the key lesson, I hope, if anybody is out there in that position right now, they're listening to this, if it does crash and it goes down by 80, 90%, whatever it is, hopefully what you do is you keep putting money into those things and eventually they will recover. There's no guarantee on that. Like, Japan is the big cautionary tale I always point to people about in terms of equity markets, is that, it peaked because of this huge property bubble back in 1989. The bubble burst right at the end of 89, and it's basically now starting to get back to even, right? And so that's insane when you think about that. That's like, 32 years of pain before you're back to even. But again, if you kept investing throughout that whole period of time, you still actually end up being okay. And if you diversified with some bonds and with some gold, it makes it even better. And it's the same thing when I look back at the time series on the Great Depression and all of that. It's remarkable. You actually could have bounced back as quickly as like 3 or 4 years with a good, well diversified portfolio across stocks, bonds, and gold, and kept putting money in. You could even shorten that further. So all things are possible. You can deal with volatility, you can deal with drawdowns, all of that stuff, as long as nothing goes to completely zero, right? And that was the pain point for me, was that individual stocks are incredibly risky, and there's no guarantee that the companies, like Nortel was the bluest of the blue chip you could imagine, right? Everybody owned that. You had to. 40% of the index, right? Finland, 70% of the index was Nokia. And
that's insane. I didn't realize it was that concentrated in Finland.
Yeah, well, smaller countries, right? If you had a huge tech giant that's in a small country, it has a huge effect on your index.
So
and
how
that's
has the economy in Finland been since Apple came along and destroyed their country with the touch screen? Death by touch screen.
So the thing that saved Canada, and the thing that probably saved Finland, I'm extrapolating here, is that the commodity bubble started to grow in the ashes of the tech bubble, right? And so there's always something out there that's gonna kind of save you, hopefully, in terms of like there's some new thing that people are investing in.
I don't know about for Finland though. Like, did they have oil or something? Or
yeah, no, they have a lot of natural resources.
In cans.
In fact, Nokia's history is as a rubber company and oil and gas company and timber company. Like they became a tech company like way more recently. That was like a 90s kind of thing, and that's why they got so excited about it. But no, they're still very much, to my understanding at least, a resource-based economy. Now, I'm not a Finland expert, so if one of your listeners out there is offended, I apologize. I don't know if you have many of a following in Finland, but so
we'll get on FinTwit. That's the other FinTwit.
Right. So the point is that, in terms of just don't blow up, and you're much more likely to blow up on an individual stock. That's why you don't do margin on individual stocks, right? And so I totally understand the pain that you went through, Ben. But I think that's part of the reason why people are so averse to using leverage when they're investing, and rightfully so. You have to respect it. You have to understand how to use it, and what's the right type of leverage, and what are you leveraging. So the other way that I sort of explain this to people is that you have to build a very, very stable table to begin with, and then you can make its legs longer, right? And that's what leverage is doing. You're lengthening the legs, but the base has to be super, super stable before you get to anything like that. And just like with a building, if you want to add another story to a building, the foundation and everything below it has to be built in such a way that it can accommodate that. And so, I think that's the mistake people make. It's that, and that margin, buying stocks on margin, was very much a thing that people did in the 1980s. And a lot of people blew up, and that's why leverage kind of went away come the 1990s. I know here, at least in Canada, it was a much more cowboy culture back in the 80s. And then banks kind of came in and became the dominant force in wealth management. And they, like our banks, are very conservative institutions, and they brought a lot more discipline to the whole thing. And like, you know, it used to be that people would graduate out of high school, go be a stockbroker, right? And that's what they were called. Now they're wealth managers. Now they're, you know, financial advisors, all that kind of thing. And so, but these days, if you're looking at people that are now going into that industry, they have CFAs, you know, they have a high level of education, and they're doing model portfolios that are given to them by the banks and all of that. So there's a lot more control around this, and the banks don't allow them to leverage things. So I'm of the opinion that it's gone too far that way, that you can actually use leverage in a responsible way and not blow up. And especially now that we have these tools. So if you want to go into some of the assets, I'm not going to give specific tickers or anything like that, but in general, you know, some of the things that people should be looking at as a diversifier is, I'll give you one, currency, right? And you guys sort of understand this because you're international investors. An Aussie who's investing in the US, you automatically understand that there's a currency bet that's embedded in terms of whether or not you're going to hedge the Aussie dollar to the US dollar, right? And I think most Americans don't really think about currency at all because they tend to invest within their own borders, and rightfully so. I mean, it's the largest capital market in the world. I don't blame them, but there's an opportunity for them to diversify their portfolios through currency. I expressly embrace that currency bet between the Canadian dollar and the US dollar. I actually looked it up to see how the Aussie dollar and the US dollar pair works compared to the US dollar, Canadian dollar. And your currency is a little bit more volatile in terms of the currency pair. And that's actually great. That means that you can use that to your advantage in terms of there's this crisis alpha that happens. So when, you know, basically like 2008 is a great example. Coronavirus in 2020 is another great example. Go take a look at the currency pair in terms of the Aussie dollar and the US dollar, and you'll see the US dollar does very well during that period of time. That means as an Australian investing in the US, if you're unhedged, you're getting that currency as kind of a backstop or a buffer to what's going on with the equity market. And the reason why is because when there's times of crisis, and it's not always guaranteed, it's not always going to be the case, the US dollar and specifically the US Treasury market is the place of safety, right? Global flows in terms of money go into 10-year treasuries. That's the sort of safety valve for the world. And in order to buy US treasuries, you have US dollars, right? And so that's what tends to happen, especially for, you know, I'm more versed in the Canadian US dollar relationship. And definitely there's a very, very strong correlation in terms of during times of crisis, our dollar goes down, the US dollar goes up. So as a Canadian investor, during 2008, I think the currency pair moved something like 20 or 30%. So that helped offset a lot of equity losses if you were invested in the US. Now, it doesn't always work in your favor. Like there's going to be times the currency is going to go the other way. But when you need it in terms of this time of crisis, that can be a wonderful way to hedge risk.
So actually, it's not necessarily the currency, it's the fact that the currency is the vehicle to buy US treasuries. Is that true?
Yes, in a sense.
Okay. On the way to get the treasuries, people are buying US dollars, so the dollars get bid up.
Right, exactly. So the US dollar will exhibit strength versus, especially, you know, for resource-based economies like the Australian economy and the Canadian economy, you know, our currencies are more linked to what's happening in Australia. It's more mining. So you guys are more linked to what's happening with base metals and precious metals. We're more linked to oil and gas. And if you look at those commodities in terms of oil and gas, what happens when things are risk off? Well, you know, usually oil and gas tends to struggle, right? And so our currency also by extension of that suffers relative to the US dollar. But in general, you know, and then for Americans, you know, if you're looking for a currency pair where you're trying to hedge your risk, then you would look at the Swiss franc versus the US dollar. The Swiss franc is sort of the next tier of safety after the US dollar, because or above the US dollar, because the Swiss are just this release valve for everybody, because they're neutral politically. They have this secretive banking system and all of that. So
well, they have everyone's money. So when everything's going bad, they all raid their Swiss bank account.
Exactly. So the Swiss franc is a nice, like, it's that same kind of currency pair for the US investor. And yeah, I think Bitcoin could potentially be that other thing, that if people want to flee US dollars, that would be another potential place they would go. Gold has also historically been, the place you can flee to if you're not confident in your currency. My background, my family comes from India. I was born and raised here in Canada. But if you go to India, there's only two assets people there believe in. It's land and it's gold, and that's it. They're not interested in holding paper in any way, shape, or form. Now that's changing, but historically, that's the narrative, right? Is that you want to store wealth, you store it in those things, because their currency has been awful for many, many decades. And they have a lot of inflationary growth there. So, currency definitely is a major asset class. I think most investors aren't necessarily integrating as an express bet within their portfolio. Volatility. So volatility has emerged as an asset class, one that you can use ETFs to express a view on, whether it's long or short. And we can go into a little more on that if you want, but volatility, I think, is a terrific asset class. In fact, Matt from Breaking the Market had DM'd me today asking about my sort of non-correlated assets. And that's what I suggested to him, is that you should take a look at integrating volatility. And, his response was, well, it has a lot of drag to it, meaning that it bleeds money. And he's right. But in my opinion, it's still worth it because it works as a tail hedge. And there's a lot of debate around this, but in my opinion, having something like that as a highly inversely correlated asset can be tremendously beneficial. Like I said, it's about the rebalancing. So don't just look at, and this is the other thing that I kind of mentioned to you guys, was that people tend to look at the ingredient list, right? We tend to look at line items in a portfolio, or we're picking something up in the grocery store and we're looking at the ingredients on the can. But what we should really be focused on as investors is the meal, right? It's the overall dish that we're trying to create. And so, if I hand you a raw piece of garlic and I say, chew on that, it's horrible, right? It's going to burn. But if I take that same piece of garlic and I put it in some butter, it's delicious, right? And it's a very simple little thing, but it makes a world of difference in terms of your experience of that. So, something like volatility, it looks like this horrible asset that why would I want to be long or short? Like, short looks better because it pays out, and it pays out until it kills you. That's kind of how it works. And the ETF provider that I worked at, we had an ETF, the only ETF in Canada that was allowed investors to go short on volatility by buying the ETF. So you went long on the ETF and you went short on volatility. And this was a huge trade for a number of years until February of 2018. Then it went to zero. Like, it completely blew up as a trade. And literally that ETF went out of business, as well as a number of other ETFs that were structured the same way.
I remember that. What was the name of that ETF?
I honestly don't even, and I'll sort of steer clear of giving specific names but it wasn't just us. It was a number of ETF providers in the US were in the same boat. And so, and it was amazing to me. It was like there were people in my office that had this product, because its annualized return was like hundreds, if not thousands of % over the last couple of years. They had this in their children's, college funds and stuff. And it was just like, it was just incredible to me. Like, these people don't even understand what this underlying thing is. That, like, can you explain to me what the VIX is? No, not really. So why on earth are you investing in that? It just makes no sense. But, volatility as an asset class is still useful. You should understand it, understand how it works and what the risks are and all of that. But, it's still a useful asset to put in a portfolio.
So what we've got so far, because I am interested in listing off the 13 items that you have to reduce volatility. What I've gotten so far from you is volatility, currencies. You mentioned gold. We've covered land. Are these the things you have in mind?
Well, yeah, we can go further. So, long, short equity. Okay. So there's ways to structure bets in terms of being, what they call a paired trade, a long, short trade of something. And you can do this, in terms of, there's a myriad of different ways you can structure this, but you can create all sorts of different long, short positions that basically have no correlation to other things out there. And you can buy ETFs that do this on your behalf as well. They exist. And what they'll actually do is hedge out the sort of general market risk in terms of like there won't be any correlation to the market itself and just a pure long short bet on whatever. And in some cases that might be a factor-based bet. In others it might be some type of situational thing, an opportunity thing. So a good example of that would be like merger arbitrage. Okay, so where there's a company taking over another company, so you're going to go long the stock that's being bought and short the acquiring company, the one that's actually doing the buying. Okay, because there's typically a gap in terms of there's a risk arbitrage means that there's a point in time that this deal is supposed to close, but there's not a guarantee, right? Like deals can fall apart. So there's a risk premium associated with, until that deal closes, the stock price, the one that's going to be bought, that it's going to be bought. Let's say the deal says that the acquiring company is going to buy the acquired company at $10 a share. What'll happen is that the market will bid up the acquired company up to say $9.50, right? And there'll always be this gap of 50 cents until the deal closes. Now that arbitrage opportunity basically shuts down because the deal is done. Right. But until that happens, there's this sort of opportunity and there's funds out there that this has been done in the hedge fund world for a long time. But today you can go buy merger arbitrage ETF where they do this on your behalf. Right. And it's what they call liquid alternative fund. And so, those types of things exist. I'll give you a long short thing that happened with my own portfolio. Like, February 1st, I was concerned about sort of, not deeply concerned, but okay, this coronavirus thing is out there and, I'm thinking about, okay, how does this potentially impact things? And really my thought process was around cruise stocks. I thought the cruise line industry was really going to get demolished if people are concerned about a virus and not traveling, right? And going back to February 1st, obviously we didn't know, most people did not know the full extent of what was going to happen. So I was just thinking about travel and specifically these cruise line stocks. And so I was like, I want to short these, but at the same time, I don't want to be naked short. I want to pair this with some kind of a long position as well. And then I was like, well, if there's this virus, then sort of the most direct bet on it would be there's got to be somebody that's probably working on a vaccine. And so, February 1st, it was a Saturday. I remember this. I spent about an hour literally just Googling what are some companies that would be working on a vaccine for coronavirus, and came up with 9 names and didn't do any deep dive on these things. It was just found a few different lists, kind of compiled them, and was like, okay, amongst these, who are the smaller companies that this would make a bigger difference to? You don't want to bet on like a huge corporation that's this multinational that, the vaccine is going to have a very limited impact in terms of their profits and earnings. You want something that's a small biotech that if this thing ends up being something that they solve or if this becomes a big issue and they're able to provide a vaccine, it's going to, cause a big bump. So I focused on those. I had a couple of larger ones, but that was just me being a bit chicken. And so I had, 9 longs on the vaccine side and 9 shorts on the short side. And the way that I broadened out the shorts was that, I had the 3 cruise stocks, it was Carnival and Royal Caribbean and whatever the other one is, Norwegian. And then, I looked for an ETF for airlines, and there was one called Jets, and it basically is like owns all the major global airlines. Great. So shorted that. And there was another ETF for gaming in terms of casinos, right? So shorted that. And then there was the hotels. So I just went through the list of major hotels, chains, shorted those. That was my 9. So I had 9 long, 9 short, 11% in each, right? So equal weighted, because I had no idea which one of these is going to do well, which one's not. And, I didn't put any money in this, to be clear, but it was something that I tracked. And so that portfolio ended up, hold on, I have it. So as of last month, end of last month, you didn't rebalance it, just keep it held throughout. I didn't close any shorts or anything like that. It's up over 500% during that period of time. And it has a negative correlation to the US market during that time, right? So that's the power of doing that kind of a thing. Like, that was an event driven kind of long short. It was just something that I, kind of built very quickly, and it wasn't, I didn't have to do a ton of research on this. It was just thinking through, if there's this virus and people stop traveling, what's the consequence of that? And I think that those types of ideas can come around. And when people think in these long short bets, the beauty of it is that, if the market tanks, there's going to be things that are going to benefit from that. And if the market goes up, then you have something else that benefits from that. So long short can be really a powerful tool in terms of how you position yourself within your portfolio. And it's not just equities. You can also do that on the commodity side. Commodities are this very diverse market of many different types of commodities and different commodity complexes. And there's spread trades you can do, there's long short pairings you can do, and then just straight up certain ones that you're long, certain ones that you're short that aren't related to each other. But that's another way that you can create a number of different non-correlated return streams. So a famous one that a lot of people do is Brent crude and WTI crude, right? Go long Brent, go short WTI. Why? Because Brent is the global benchmark for oil, and that price tends to be much more stable, and it tends to carry a price premium over WTI. WTI is a much more localized price here in North America. And so all you're capturing is just the spread between these two things, right? So if oil goes down, oil goes up, I don't care. As long as Brent goes down less than WTI does, as long as Brent goes up more than WTI does, I make money, right? And that's the beauty of these types of trades. It's non-directional. It's about the sort of spread between these two things. And that's what I care about in that context. So, there's a myriad number of those types of things you can do within commodity markets. And then, hold on one sec. Crypto is another, obviously, asset class. Trend following. So that's not necessarily an asset class, but that's an approach in terms of gaining or fading exposure to different asset classes that can give you its own differentiated return stream. So you could literally have a sleeve of your portfolio that's doing, particularly if you do short-term or a short trend following, in the sense that you're using very short-term signals to do your trend following. Again, this is going to look more like that sort of volatility thing where it bleeds money over, these sort of like periods of time where things are trending upwards. But in times of crisis, they can pay out very nicely. But you can tune that trend following model however you want. You can have medium-term trend following, long-term trend following. You can have a combination thereof. But that's a way to create an independent return stream that isn't, it's not connected to any one thing. You can do that across many different assets.
So you're using, I like this term you've introduced, independent return stream. I think that's perhaps a more useful way for an amateur to think about what you're setting up.
Right. And so it's not just about asset classes. Asset classes are wonderful things to give us diversification, and you should, be invested in very, very broad asset classes. But then it's also about the mechanics of how you put these things together. So, again, bringing it back to cooking, you have ingredients, but you also have technique in terms of how you cook things, right? If I take a piece of meat and I braise it, that's a very different thing than grilling it versus, doing this and doing that. And it's all beef, right? It doesn't so. I think that's the other thing that escapes people, is that and by the way, there's also a lot of these things you can do through exchange traded funds where you're not having to do your own long, short, equity stuff. You can have a fund that provides you that return stream. You can have a market neutral, hedge fund like strategy that's in an ETF wrapper. And so hedge funds are great in terms of innovating these ideas. A lot of smart people work at hedge funds. I had the opportunity to work alongside them and get to learn this stuff. But the issue is that in the past, it was a 2 and 20 model in terms of what they're charging. 2% management fee, 20% of your upside in terms of your profits, right? And the 2%, I'm not too worried about that. I can live with that. The 20% performance fee is the thing that really kills you, because it's designed to benefit the fund rather than the investor. So the beauty is that now we have these liquid alternatives where these same strategies, now you could argue that they're a bit watered down, fine, but they're now available in a very liquid format that's much cheaper, where they're not charging a performance fee. The fees are still going to be a lot higher than what you get with a traditional ETF. But I would argue that, like, I don't care about the fees as much as, if I put this in my portfolio, do I get better returns or do I get more stable returns? Because what we're trying to do here is really get the best risk-adjusted returns we can. We want to find the most efficient portfolio we possibly can. And then if you want to get to a certain return level, that's when you add leverage. And this is, in fact, Finance 101. This has been known since the 1950s with Markowitz and the efficient frontier of modern portfolio theory. You have two assets, stocks and bonds. You find the sort of maximum point of efficiency in terms of the max Sharpe ratio, and that is the point that you then point of tangency to the capital market line, and that's the most efficient portfolio. Now, if I want to hit a certain return target, I add leverage to get there. That's more efficient than trying to load up on equities, right? If that's a less diversified portfolio, a less efficient portfolio. So it's kind of like with a car, right? I can get from point A to point B, but I have to have a measure of efficiency between two cars to judge if one has done a better job of getting from point A to point B, right? And so let's take it as fuel efficiency. If it took me 100 liters of gas to go 100 kilometers, that's awful. If it took me 1 liter of gas to go 100 kilometers, that's fantastic, right? And I think that very often, the average investor, what they're worried about is just the number. I drove 100 kilometers. That doesn't matter. Anybody can drive 100 kilometers. Anybody can get you a 10% return. It's how much risk you took to get there. And so that's what matters. That's how you measure efficiency when it comes to portfolios.
It's actually really great. As you've been going through, I've written down all these terms you've used, Jagdeep, realizing how much I have to learn. I don't want to count them all here, but I reckon it's over 20.
What you're saying here is quite a sophisticated, while the tools are accessible to a lot of people, it's somewhat sophisticated in terms of building this portfolio. Even though you've got the tools, you do need to do the background education. What's your view on that for a basic investor, someone who's got a feel of index funds and the basics of ETFs and bonds? How applicable or easily would it be for them to replicate something similar to what you're doing?
Probably not that easy. I agree. I'm kind of giving you, it's like if you're taking a basic cooking intro class, right? You start with learning how to just chop an onion, right? Or cooking an egg. And then, you're thrown into some advanced class where they're doing, really fancy stuff like sous vide and this and that. And so that's sort of the world that I kind of come from, in the sense of understanding these things and then understanding that you can express these things through ETFs. I think that going forward, we're going to see more and more of this stuff start to come to the fore, because these products are still pretty new, right? Like basically a lot of these alternative strategies, and they're still kind of coming to the market in a lot of ways. But you didn't start to see really any of these things until around after 2011, 2012. It took, the global financial crisis, and there were some bad return years after that, now the industry started to focus on, okay, well, we've got to find stuff that maybe isn't just stocks and bonds. We can do something else with it, and looking to the hedge fund industry to kind of like bring those ideas over. So, I get it. Like it's sophisticated, but ultimately, if you understand these things and you can kind of identify them as products in the market, I'm like I said, I'm kind of an ETF geek. I know this stuff a lot. I am very familiar with the whole product range out there, and not just the stuff that everyone knows, but the more sort of esoteric stuff. And I think that if you do your due diligence on this stuff as an individual investor, there's an opportunity to kind of recognize, oh, okay, yeah, I see how this thing can fit with this thing. And because the way I kind of approach it is the equities are like the engine, right? That's going to be the main sort of driver of growth. And then what you've got to have is a bunch of other things that are the safety features in the car, in terms of the airbags, the seat belts, the brakes, and really high performance tires, all this stuff. All of that translates that power of the engine into usable forward motion that you can control, right? And stop if you need to, right? Like high performance cars don't just have great engines, they have amazing braking systems on them, way beyond what a regular car does, because it's about the agility, right? And so ideally, and I'm not getting crazy fancy with like how I put these things together, in the sense that I do a very simple buy and hold, rebalance on a quarterly basis, but using a very, very broadly diversified set of tools. That's what I do. And so, and to give you an idea of the types of returns, like my portfolio did 73% last year. And this is the thing that I think is really impressive, is that from February 19th to March 23rd, when the S&P was down 34%, this portfolio was down 1.5%. That's convexity, right? It's getting the upside reward of taking risk, but cutting off that far left-hand tail when everything goes to shit. And so, you have to know what you're doing to achieve that, right? But if you do...
So that says your 13 uncorrelated assets are, in fact, uncorrelated.
Correct. And I'm not saying that that's forever and ever amen, right? You have to, like, correlations change, all of this stuff shifts. Like, it's not a fixed thing, it evolves over time, right? But the point is that, there are ways to do this. And like, the Sortino score on this thing is like 4. And I know that probably means nothing to you, but that's like fantastic. That means for every unit of risk we're taking, we're getting 4 units of return, right? And that, again, is, like I had mentioned in my notes to you guys, that we as human beings, we're looking for our utility function in terms of what we're looking for from our portfolios is likely convex, in the sense that I want all the upside and I don't want any of the downside. That's how we as humans operate, right? It's not necessarily realistic, but that's what we want. So if that's what our goal is, then we should aim to build a portfolio that sort of aligns with that in terms of our natural tendency for what we're looking for. I want all the returns, but I want to truncate, the big risks. And so, that's convexity. And so if I'm doing a good job in terms of portfolio manager constructing a portfolio, then I should build something that is aligned with that as a convex function.
It leads me to the question, are there any ETFs doing, I know you've already talked about the long short ETFs and so forth, but are there any ETFs out there that are doing something similar to what you've done?
Again, I don't really want to give out specific tickers, but yes, like in fact, there's stuff out there these days. It was launched, pretty recently, and this is in the U.S. market, where they're using these options to give you convexity on the S&P 500. And if you kind of do some research in terms of S&P 500 ETF convexity, I'm sure you'll find it. I don't mean to be cagey. It's just that I'm in this position right now where I'm not currently licensed because I'm sort of out of the industry right now, but I'm going to be kind of going back into it. And I don't want it to be construed as me giving investment advice or specific, sort of things that people should be doing.
That's totally fine. I thought your guidance there was really useful. If you go onto Google and type in S&P 500 convexity, you will find some information. I think that's very instructional to say.
So we're up to 9 now that I've written down.
Okay, and so I mean the other thing I would mention. So yeah, some of them aren't going to be sort of broad, like. So within long short equities, within long short commodities, within volatility, there's like things within that are like specific ETFs or products or strategies or whatever that would kind of bring that to a broader number. The other thing I'll mention is that there's also something like time scale diversification. Okay, so I know you guys did like a value investing course. So value would be what we call a convergence trade that happens over long periods of time. Okay, so if you're talking about value, traditionally speaking, at least, it depends on the value that you're talking about, but usually value takes time to play out, right? And I think, Will, you'd even mentioned this in terms of like invest in a team, let them do their thing for 5 years, and then they'll sort of give you the results that you're hoping. And so that's fine. Value is probably, I would say, closer to maybe a decade in terms of like really playing out the way that you hope, if you're looking at intrinsic value and the company sort of realizing that intrinsic value. But then, if that's your long time scale convergence trade, then you can also do stuff that's shorter term, right? And like I said, you could do trend following, but you can also do something like momentum. You can do that cross-sectionally, you can do that on an absolute basis. But the point is that, you can have these shorter time scales that your ideas are playing out. And so, that can be another form of diversification in terms of playing across these different timescales of how things are going to play out according to framework is.
One question I want to follow up on is you talked a little bit about the history of investing in the sense of in your father's days it was stock trading, and then that moved into the 90s, mutual funds, and then ETFs. Currently, you may have already touched on this, but where do you see the future of products and investing possibly going?
That's an interesting question. I think that it'll probably have something to do with blockchain and in terms of that being a new avenue for distribution of financial products. And I know that, I'm not a crypto kitty type of person. Like I'm not big on the whole idea that crypto is going to upend the world and free all of us from the bondage of banking and all of this stuff. But I do think that it's going to be a disruptive technology. And I do believe that part of the reason why you're seeing Bitcoin where it is today and where it'll probably go in the future is not because it's outside of the financial system. It's because it's going to be brought into the financial system. Okay. And so going forward, I think Bitcoin is going to eventually become a very like sort of boring asset class in a lot of ways. Like it'll exhibit a very similar volatility profile to other sort of like financial assets, and it'll look a lot like other things. But the blockchain, in terms of like this channel of distribution, is really, really interesting. It's smart contracts and all of the other stuff that's going on there. In fact, you're already seeing this. There's funds out there that have already done this, where they have the KYC requirements, know your client, and for each jurisdiction, right? So it doesn't matter where I live in the world. If I, basically open up this application, and it's all lives on the blockchain. I open this up on my computer, it knows exactly where I am and will show me all the proper documentation for my jurisdiction for me to be able to subscribe and become an investor in a given fund. Okay. And so I think that is really interesting, because the disruptive technology around ETFs versus mutual funds is this aspect of decentralization, in the sense that it's centralized on an exchange, but exchanges are much more open platforms than mutual funds are, because mutual funds, they actually have to know something about their end client, right? They have to send you your tax forms and whatever. So that happens on a domestic level, right? So if I'm a Canadian, I can't invest in an Australian mutual fund. If I'm a Canadian, I can't go invest in a US mutual fund, and vice versa, right? Whereas with an ETF, as long as my broker provides me access to that exchange, right? If it's the ASX, it's the TSX, or it's the New York Stock Exchange, doesn't matter. I can buy an ETF that exists on that exchange. And I think the next level to that would be no exchanges whatsoever. Instead, I just open up an application, on my phone or on my computer, and it's all living on the blockchain, and anywhere, anyone, if they have the money, if they have it on the, whether it's a digital currency or whatever, will be able to purchase that fund and be able to put it in their portfolio. I think that's really amazing. And I think that that's likely what we're going to see in the future. So to me, that's kind of exciting and cool, like the level of capacity you can bring into a fund when it's available to everybody everywhere is pretty amazing. And I think you'll have a best of breed in terms of ideas, right? Like global competition, that's what it does. It culls the weak and it gives you the best, the very, very best. So,
what you've just summarized there is the information age, actually, which was something we touched on in one of our episodes. Because information technology and our global communication infrastructure, anyone from anywhere in the world can work on any problem, which means that people from regions where cost of living is lower, cost of education is lower, etc., have an advantage. But you've just described another implication of the information.
For sure. And I think that's really exciting. And as pessimistic as I sometimes am, we're talking about risk. I think a lot of people in the world of finance, you ask them what's a risk right now. They're worried about inflation. They're worried about QE. They're worried about this and that and Federal Reserve and central banks and stuff. Fine. But, the real risk is, or coronavirus, but the real risk is global climate change, as far as I'm concerned, and mass extinction and the fact that we're killing this planet. That is by far, to me, the biggest tail risk that any human being on this planet faces. And it doesn't matter how diversified I am across all these different wonderful asset classes and strategies and stuff, like none of that is going to do anything if we can't breathe the air, we can't drink the water, and we don't have any animals.
You're talking to two Australians here who've been marinating their entire lives in the news output of News Limited. Climate change doesn't exist according to
Rupert Murdoch?
Yeah.
So here's an alternative asset class for you. I also worked more recently at a firm that does capital advisory, and our niche was really, I'm not with that firm any longer, but their focus was really on sustainability and impact investing. And so, one of the companies that we were kind of working with was called WorldTree. Look them up. And what they have developed is this whole program around planting the fastest growing hardwood tree in the world. Their sort of target market is really coffee plantations, because coffee plantations need to plant shade trees. Okay, so the farmer ends up taking care of the tree. This tree grows to full maturity within 20 years. And it creates this beautiful hardwood that can be used for furniture, instruments, all sorts of stuff. And so the farmer gets, I think it's 50% of the proceeds. Like, so when the tree gets harvested and gets turned into lumber, farmer gets paid out 50%. 25% goes to the company and 25% goes to the investor. But the beauty of it is these things sequester carbon like crazy, right? And so, this type of thing I love as not only as a non-correlated asset, but also as something that you can do within your investing portfolio to potentially hedge against the biggest risk that we all face, which is that we're all going to kill ourselves as a species on this planet. And so, I think, this idea of diversification and hedging, you can broaden that out a lot further than just strictly, sort of financial assets, and you still financialize some of these things. Like there's a bunch of companies that we were working with that were doing really cool things, and that's just one idea. But trees and investing in the idea of planting trees around the world, I think is fantastic. And
that's a wonderful idea. I love it too.
And so I'll send you the link to the hold on one sec, website up. But like I think we really need to be thinking along those lines. I give credit to big ETF managers like BlackRock. They're taking this very seriously. And if you read their stuff, and ESG has become this very faddish kind of like thing within the ETF world because there's a lot of money flowing into it now. But that's fine. I don't have a problem. I don't care if you're cynical about any of this. It doesn't matter to me as long as the behavior ends up changing, right? And so if it ends up resulting in people investing their money in such a way, or gives them an avenue to invest their money in such a way as to like reduce the carbon footprint of their portfolio, or make it more socially just, or et cetera, et cetera, et cetera. Great, and
I love the idea of having hedge funds engaging in making the world more socially just. That is a fantastic idea. Having the smartest money managers in the world working on making the world more equitable. Yeah, this would be a great.
And I think anyone that's a thoughtful human being, they understand that we can't just, destroy the planet and we'll be okay.
That's also true. Yeah, it's actually favorable to human survival to have the smartest people in the world who work for hedge funds working to ensure our survival. You mentioned it. Yeah, thanks for the link about worldtree.co. I'll put it in the show notes. But I just wanted to touch on some behavioral issues. So you mentioned a behavioral issue there, the social justice trade being a fad. But also I wanted to hear from you a bit of commentary on the behavioral reasons why people do not diversify across these 13 asset classes. And in preparing for this interview, you mentioned some of the behavioral reasons why people don't participate in the massive Cambrian explosion of ETFs that has happened. So could you give us a bit of commentary on your thoughts on behavioral factors?
Well, I think Ben gave me one already, just in terms of, not understanding what the hell any of these things mean and what they are. And so maybe I'm a little too inside baseball. And so to me, like, oh yeah, sure, of course. Why wouldn't you do long vol in your portfolio? But I think for a lot of other people, that's something completely alien to them. And so they don't understand it. Stocks and bonds have been around for a very long time. Gold has been around for a very long time. And even that is still considered an alternative asset, which kind of blows my mind in terms of gold. To me, at a minimum, that should be your 3 basic building blocks for a portfolio. And by the way, if you do that, 40% stocks, 40% bonds, 20% gold, or 45, 45, 10, I think you're way ahead of the game compared to the vast majority of portfolios out there. So, if you want to have a very, very simple portfolio, do that, rebalance it maybe on a quarterly, semi-annual, annual basis, and you're going to be good. You guys are talking about, and I'd like to talk about a few things that I had notes for myself after listening to some of your stuff. But so behaviorally speaking, I think these things can be exotic and scary, so they're unfamiliar. Okay, we have familiarity bias as investors. We want to invest in things we understand and we're comfortable with and we get, and aren't too weird. So there's also this herding aspect to it, in the sense that we're gonna feel much more comfortable earning or holding the same thing that our neighbor does. It's that idea of buying the most popular whatever it is, album, car, what have you, because there's wisdom in crowds, right? And if you don't do what everyone else is doing, then you're kind of sticking your neck out. And definitely from a regulatory standpoint, that's definitely the case. Regulators aren't in the business of making people super wealthy, or allowing things that are outside the norm into the system, right? But there are a lot of interesting ETFs that have come out over the last decade or so. I think that part of it is also the paradox of choice. So like you said, there's been this Cambrian explosion. There's so many ETFs out there. There's so much noise. It's hard to separate the signal from the noise in that. And the paradox of choice is really that when we get presented with too many choices, we shut down. We almost don't make any choices. Instead, we just say, you know what, I'll just go to a robo-advisor and let them do it. And by the way, nothing against robo-advisors. They are fantastic. And I think most people would benefit from using it versus doing this themselves. But are robos with their 60-40 portfolios the most optimal thing? Probably not, in my opinion, where we are right now. You want to have something beyond just 60-40 stocks and bonds. I think there's also this, like I said, this sort of focusing on line items. So if I showed you an ETF where it shows negative compounded growth on a year after year basis, on a very consistent basis, you would say, Jug, you're out of your mind. Why the hell would I want to put this in my portfolio? And on its own, as an ingredient, you know, it looks like eating a raw piece of garlic. You don't want to do that, right? But if I put it into, you know, my spaghetti sauce, it's phenomenal, right? And I think that's the problem, is that people look at it line item by line item rather than the collective whole. And you know, it's a gestalt. It's the sum is greater than the parts, and it's easy to lose sight of that. It's easy to just look at the returns for a given ETF and say, well, that looks terrible, I'm never going to buy that. And you have to dig a little bit deeper. You have to kind of put it through a correlation matrix and see what's the impact on the portfolio. And lo and behold, something that looks awful. And by the way, you know, like one of the ETFs in my portfolio, it annualizes at like negative 18% a year. It's done that for almost 10 years. And yet, if I put it in my portfolio, it's so negatively correlated with everything else that it provides benefit, and it actually boosts my overall returns. It's counterintuitive. It's a non-linear thing. And our brains are not built for understanding nonlinear things. That's why options are weird, and that's why correlation matrices are not intuitive to a human brain. You really have to go through and kind of do it and get a feel for it, that you start to understand. And so, you know, that's sort of the shift.
Yeah. Sorry, I just wanted to butt in. You're reminding me of the Mutiny Fund from Taylor Pearson. I don't know if you've heard of him, but he actually introduced me to Matt from Breaking the Market. Right. So I remember reading an update from the Mutiny Fund. Basically him, to me as an amateur, he was sheepishly saying how it didn't increase in value over whatever the reporting period was. But now I have the context from you about, because he kept saying how in the context of a broader portfolio, it would still be a useful, or it one day would perform a useful function. So is that what you're saying?
Exactly. It's basically, it's something that allows you to take more risk elsewhere in your portfolio. Okay. And so when you understand that, right, that like, okay, I'm carrying around this roll cage in my car that's adding a bunch of weight, and it's annoying because I could go faster. But the roll cage is the thing that lets you drive faster, right? Because I know that I'm not going to die in this car. And that's the difference, right? So I can take those corners a lot faster than I would otherwise, because I have the safety of this thing around me. And so I can put more leverage, or I can put more equities, or I can do this, or I can do that, because I have this thing that when vol suddenly blows up, it's going to do really, really well. Right?
We actually had lined Taylor up for an interview, but because of my misunderstanding about what he was doing, I sort of thought that it would be better for us to interview Matt. I somehow thought that Taylor was failing at what he was trying to do, but now you're saying actually his
job is not to bleed too much money along the way. So it's going to bleed, right? That's what tail hedges do. There's kind of no way to get around that. But it's a question of how much money am I going to bleed? It's think of it exactly like an insurance policy. Okay, every month you write your insurer a check, right? Whether it's car insurance or home insurance or life insurance, right? And you're not getting anything back for that, not until something bad happens. When something bad happens, then they pay out, right? And so the expectancy of that is that it's going to be negative during the whole period of time that you're paying out. And ideally, here's the crazy thing, you hope that it never pays out. You hope that you wrote all these checks for nothing, right? Because being dead is not a great payout. And so, like, if we're taking the example of life insurance or having your house burned down for home insurance, you hope you never ever have to collect on that insurance. Sorry, go ahead, Ben.
What if the insurance company goes under as well?
Then you're fucked. And so you have to pick your insurer properly, right? And that, what you're referring to is counterparty risk, right? So you have to make sure that you pick wisely. Yeah, and so this is a great point. I don't know if you guys have read The Big Short, but one of the things that I took away from that, and I think is really important, is understanding that you can get the call right. Right? Like the one guy in there, I forgot his name, but he got the call right in terms of all these mortgages are going to fail. I want to take the other side of that trade. And his counterparty was one of these big banks. And basically they fucked him. They said, we're not paying out on this. Right. And so
this is Ben's hero, Michael Burry.
Right. Yes, exactly. Yes.
About it.
Right. And so, there's something to be learned there, is that, you have to pick your counterparty very carefully. Now, the nice thing about using an ETF to express these types of things in terms of going long volatility or whatever, the underlying, like I said, is a futures contract. And so for the most part, it can be swaps. You kind of have to get into the nitty gritty of this to look at it. But the futures contracts are done through a clearinghouse. The clearinghouse is like a bookie. Bookies basically balance their books, right? They make sure that there's equal amount of bets on the winning side and on the losing side, and so they're delta neutral, right, in terms of their position on a given game or outcome, right? And that's exactly what a clearinghouse does. So every single futures contract has a buyer and a seller on each side of that contract. And so the clearinghouse makes sure that all of these things are centrally cleared and balanced. And then so let's say I'm a futures buyer, Will is a futures seller. You then are responsible to deliver whatever you're supposed to deliver in terms of margin to your broker. And the broker will extract their pound of flesh from you in order to make sure that you deliver on what you're supposed to do on your futures contract. So, there are these inbuilt things in terms of, like, there's a robust structure. To my knowledge, no futures clearinghouse has ever gone bankrupt. Brokers might have gone bankrupt, but there's a whole system around, they basically, there's regulators and insurance, both public and private, that steps in and ensures that, nobody goes bust on that.
I'm just wondering if there were any other behavioral or even neurological or biological factors you wanted to discuss, again,
sure,
which prevent people from fully realizing the opportunity that you are highlighting of increasing geometric return through employing more than the typical 3 asset classes.
Right. Well, I think, like I said, there's a lot of barriers to people building sort of optimal portfolios. Another one would be like being leverage averse, right? And even though, like I said, this has been known since the 1950s. Like, we've had modern portfolio theory for a long time now, and it's still something that I think the average investor, and even to a degree at the institutional level, this is not employed, right? It's because there are constraints, right? Like, if you do something that is outside the norm, think about it from a career risk perspective. Like, if you're running a pension fund or you're running professional money, if you build an quote unquote optimal portfolio, even though Harry Markowitz with his Nobel Prize told you this is the way to do it, but nobody else is doing it that way in terms of taking a 60-40 portfolio and levering it, then if it blows up, what's going to happen? You're going to get fired, right? And your children are now going to be wondering, how am I going to get my private school fees paid for?
The issue of career risk that I often hear
right.
fund managers talking about.
Exactly. So sticking your neck out and doing something different than everybody else is risky, right? And it's risky for an individual because we seek this herding behavior because it's easier to take your losses when everybody else is taking their losses, right? It's easier to lose your shirt in 2008 because everyone else is doing the same thing, right? And it's more euphoric to be part of the tech bubble than to sit out and watch everybody else make money, right? So that's how we get sucked into these things as human beings. We're social creatures. We're seeking social proof and social acceptance. And so we do these things because not necessarily the most optimal, but because they give us a warm feeling inside, right?
So we're confusing what our true goal is. So rather than generating a return, some people might actually have as a higher goal joining the crowd, being
Right.
respected by their peers, and
Right.
therefore their eye goes off the ball.
Right. Right. We're optimizing something else now, right? And
Great way to
so
put it. You got to, seeking to optimize the right thing. Yeah.
right. And so I think that's a big part of it. And you can't ignore that. I think that's part of being a human being, are these features, right? And you can see them as bugs. I think that they're just part of the framework that makes up who we are. And by the way, I think it's also interesting that all the foibles, all the good things and bad things about us are also getting reflected in our machines and in our AI and our algorithms, right? They're picking up the same racism, the same, like biases that we have. And it's interesting. I also have seen this on the investment side. Like I literally worked at a firm where, we had these Korean guys running the first, totally automated ETF in the world in terms of the portfolio manager was a machine, right? But it sounds great. It sounds like you're taking all the emotion out. But the reality is that you've just sort of you've taken the emotion and separated it by a machine that still reflects all of our issues as human beings. Because for this one machine was supposed to be doing everything, but I looked around and I saw about 12 different Korean programmers that were in our office that were like constantly monitoring this algorithm, tweaking it, doing that, and the performance was terrible, right? And I think that that's a real problem in quant finance and in terms of like this reliance on using algorithms and machines and all of that. I have a process. I believe in having a process and framework, and it should be quantitative to a large degree. But I also I'm more towards that kind of quantamental approach in the sense that we as humans have these amazing things in our heads that are amongst the most complex things we can find in the universe, our wetware. And we shouldn't be afraid to allow that to express itself and be a part of that process.
That's exactly the direction that Ben, so when Ben and I sort of started off, I realized a couple of episodes ago, I think it was basically at the end of Matt's interview, I sort of realized what it's kind of bifurcated the behavioral investing approach. One school of thought or one camp is trying to take away emotions, essentially lives in fear of the day that a human makes a decision
Right.
based on the assumption that it'll be filled with emotional overrides and it'll be incredibly damaging to your financial well-being. The other camp, and this is the direction I'm hoping to, I'm glad you brought this up. It's part of this this new direction I'm sort of seeing is how can we actually be as emotional as possible, or maybe more to the point, leverage our capacity for automatic processing that emotions are.
Did Ben want to add to that? No, okay. I think that there's a balance that can be struck. There's going to be points, like for example, rebalancing into the end of March of 2020 was not a fun experience, right? Even for me, in the sense of like, there's some things that there were some assets that had just gone down. Like, if you're looking at some of these things like a 3 times levered S&P 500 fund, it was down almost 75% during that period of time from February 19 to March 23rd. Am I super enthusiastic about rebalancing into that? No. From an emotional perspective, hell no. And so, I think you have to have certain things that are going to help ballast you in those moments. Now, the good news is that if your aggregate portfolio is not down a lot, but again, like I said, we as humans, we're always going to look inside of that at the line items, right? And some of those things are up a lot, some of them are down a lot, and it's like crazy volatility. The aggregate is working beautifully, but when you're actually doing this yourself in terms of rebalancing all of these different things, Yeah, you have to have a lot of dedication to your process and to understanding that in order for me to get this return, whatever the return is, you have to understand what went into that, in the sense that, like, if the process says I have to rebalance quarterly, right? Then you rebalance quarterly. It doesn't matter if the quarter that just happened was horrendous for you or terrific for you. You don't get to kind of pick and choose now when I'm going to do my rebalance, right? You got to do it. And so, and there were actually funds out there that, like, they kind of delayed their rebalancings, right, during this window of time because it was so volatile. And sure, that's a decision. I'm not saying it's the right or wrong decision, but it's a decision that was made. But in my opinion, like, if I'm looking at something and I'm saying, okay, the back test shows me if I do X, Y, and Z and I get this result, then I kind of have to mentally prepare for the fact that I'm going to do that no matter what. And so ideally, that is a type of thing I think that should be taken out of the human hands, right? If you can do rebalancing on a automated basis, I think you're far better off, because there's much more, like, that's to me a fail point that's likely in terms of your emotional thing. I think where you can harness the insight and the human mind is understanding that, like, okay, like the long short example I gave to you, where, no algorithm is going to be able to pick up on that in terms of, like, here's a virus, here's how this would potentially play out in the global economy, and here's some sectors. That's a human thing, right? That's a human synthesizing information. And I think that can be useful. I think that, like, you're starting to look at this narrative start to play out of inflationary growth, right? And that was a signal that you might start to pick up on when you're reading that everywhere. And it's like, okay, maybe I want to tilt a little bit into some inflationary sensitive commodities, right? And so I think that that's something that is harder to code. You can do it, and there's nothing wrong with that. But I'm more of the mind that even if you do code it into something, we're better off doing something where we're tilting rather than having extremes in terms of I'm out of this asset, I'm into this asset. Instead, I would much rather hold this very broad basket that's thoughtfully put together and rebalance it on a regular basis. And then we could, if you want to get a little more dynamic with it, you can do a little bit of tilting here and there, but that's really it, in my opinion. And so, I think no matter what you do, the human is always going to be at the center of this. Whether you're programming this into a computer as an algorithm, it's still a human that's deciding the parameters of that algorithm, always, right? And even if we're talking about machine learning, there's still a human that's feeding data into that machine learning system.
A human is choosing which data sets to train
Exactly.
the deep learning neural net on. Yeah.
Right. And you're also deciding which outputs are valid, and you're developing a whole
That's
architecture
also
around
true.
this.
You define what the learning success is for the neural
Right.
net. Yeah.
So there's no, it's kind of like in quantum theory, trying to, take yourself as an observer out of the system. You can't. And the idea that I'm going to just create a machine and now I don't have human emotion involved, I think is a complete fallacy. And I think that people delude themselves if they believe that as quants. You are making active decisions and bets no matter what. Even the S&P 500, to talk about it as passive, I think is a misnomer, because
No,
the
it's
truth.
not. There's a meeting to
Right.
decide which goes in, and Tesla should have
Exactly.
been in based on the rules of the largest
Right.
company much earlier than it was.
Right. So that's I think a great example. You hit the nail right on the head with Tesla, and so I think that this idea, we kind of, this is the mental game that we play with ourselves as humans, is the belief that we can kind of like divorce ourselves and our emotions from all of this. What I would say is this, in terms of, like, how do I approach behavior and all of that in terms of investing. I think the best approach is really having a portfolio that is not going to behave in a way that you can't tolerate it, you can't deal with it. So you have to have a portfolio that conforms to your makeup as a human being. And I think that varies person to person. Some people are very contrarian in their nature. I would say I'm a little bit like that. I'm an only child. I've never really felt the same kind of pressure to kind of fit in with everybody else. And so for me, it's totally natural to do something that's outside the norm. I don't really care what other people are doing. It doesn't matter to me that much. But I think for a lot of other people, that would be very difficult. They're not inside their heads maybe as much as I am. So I think, I had mentioned to you that you kind of have to have this utility function of, this is who I am, this is what I'm trying to do. And this would be sort of a portfolio that reflects those views and how I am as a human being. And if it fits with all of that, then you're more likely to stay on the path. And I think that's the most important thing. There is no one optimal portfolio. There's many, many paths to Rome. And what you have to find is a road that you're comfortable taking, because the worst thing you can do is jump off of whatever road you've been going on onto some other road that you have no idea where it's going and how it works and who, you know what I mean? Like, you're going to get turned around and you'll never make it to Rome. So you gotta, whatever path you choose, you got to stick with it. And like I said, if you're going through hell, keep going, because eventually you'll get through it. And I think
as a behavioral management approach, then success for you is, in a time of low emotional turmoil, coming up with a set of rules, and then your successful behavioral investing for you is staying the course through the time of emotional turmoil.
A guy like Warren Buffett, right? He's built differently than most people. Him and Charlie Munger, and people often forget about Munger, but that dude is a serious shark and very, very bright, and big reason for why they get the returns that they get is that they both understand that, like, okay, this is the path we've chosen. We're going to be these people that we believe in America, we believe in the stock market, and come hell or high water, the best approach that we've seen is owning great companies for the long run. And there's going to be times along the way where our portfolio might drop by 50, 60%. And that's just the way it is, right? And if you have the emotional tolerance for that, God bless you, go do your thing, But for most people, I would say that's probably not the case. I think that ideally, the way I think about it and the hedges that I have, they're these parachutes that slow time down and allow me to be able to make adjustments if I need to in real time without panic, right? So like I said, when we saw that drop from February 19th to March 23rd, that's a 34% drop in the S&P 500. That's the fastest that we've ever seen, even faster than the Great Depression, faster than the global financial crisis. It was petrifying, right? And what gives you solace is seeing, okay, my portfolio isn't doing that. Like, it's dipped a little bit, but it's like barely budged. And so that gives you the ability to be able to, like, okay, do I need to make an adjustment here? Don't I? How do I feel? I could have cashed out if I wanted to.
Yeah, I think what you bought yourself there, or what you've devised for yourself, is a system which doesn't activate the limbic brain.
Right, exactly.
You bought yourself a chance which others didn't have to remain directed by your neocortex. What I'm doing here is so you made a great comment in your notes about what we would talk about in the interview. You said here that we need to understand our true risk tolerance and the fact that we're governed by our limbic system, but not the neocortex. It seems like through not going through the volatility event that everyone else went through, which would have triggered their limbic system, which would have caused emotional overrides and kicked them out of the market, basically, you didn't go through that stress. So you got to remain directed by your neocortex. You were able to continue analyzing where others went into emotionalizing, if you like.
Right. But so what's interesting though is that, like, it's not that, that risk doesn't just go away completely. Like, the drawdowns change when they happen, changes, right? So like now, the last couple of months have been kind of rough, right? Like, you're down about 6, 7, 8% year to date, right? And so you're going to take your lumps. It's not like, I've built this thing that's perfect and will never have a drawdown. Like, that's not the case. It's just the drawdowns are different. And I'm not super correlated to what's happening in the stock market specifically, right? So you can't, Corey Hoffstein is a guy that you should hopefully get on your podcast at some point. But, one of the things he says is, risk can't be created or destroyed. It can just be, transferred. And so we kind of take our risks, there's a certain amount of risk in whatever distribution. It's a question of, is it going to live out in the extreme tails, or is it going to live closer to the mean where I see it on a more regular basis? And I know my preference is to see that risk on a more regular basis rather than on the more extreme ends of the tail. And so what that means is that, like, you're going to take your lumps more regularly, but you see what those lumps are going to be, if that makes sense. That distribution is more sort of transparent to you because the risk is in the main body of that normalized distribution. The thing that's scary, or should be scary to investors, is the left tail risk, right? Because you don't know what that looks like until it happens. And so as much as possible, if we can squish that down or truncate it, then we've pushed that risk over, right? If you think of that normalized distribution, if I cut off that left tail, it doesn't go away. I'm just pushing that area under the curve to the right. And I'm pushing it hopefully throughout the whole distribution that's remaining, if that makes sense.
Excellent. We normally wrap up our podcast with a couple of questions that you may have heard on previous episodes. But I hope you entertain us by allowing us to ask these.
Sure.
The first one is, we've solved the physical hygiene problem. We've all used soap and we wash our hands. What about mental hygiene though? What should we start doing as a mental hygiene equivalent of washing our hands?
In regards to?
In regards to mental hygiene. So we're talking about behavioral investing. What things can we do mentally? What activities should we be doing? Or what, some hosts in the past have answered that by saying, use checklists. Others have said meditate. From your view, what should we be doing to have better mental health?
I don't know if I'm qualified to give advice on here's how I would respond to that. I think that it might be the wrong approach, and I say this gently to you guys because I know big on this idea of mastering oneself in order to be successful at investing. I would posit to you that that's a fool's errand, that we can't really control ourselves as humans. We have this idea that we do, but you're fighting against, as Will and yourself have pointed out, hundreds of thousands of years of evolution as Homo sapiens. And the idea that I'm going to be able to control my limbic system and all this stuff, I think, is a bunch of horseshit. I think that what you need to do is build a portfolio that doesn't trigger any of that to begin with. And if you do that, then you have a much higher level of chance at success. And you also have to understand that our monkey brains also want to participate in these like bubbles and all of that, and that's fine. And that's where you do bet sizing. That's where you do a very, very small portion to scratch that itch. And it allows you to, and even if you want to take a small sliver of your portfolio and go day trade it like a maniac, feel free, as long as the amount of money that you lose isn't going to blow you up in any material way as an investor. If you want to waste your time doing that, feel free, but I think honestly that this idea that I'm going to be able to
become a Zen master.
Yeah. I was going to say a Jedi Knight or something like that, where I'm going to be able to control all these things. I just don't really buy into that. I think
I've had a similar view. I think I made a tweet about that. Basically, maybe as behavioral investors, what we simply need to do is become familiar with what our instincts are, how they're activated, and as you say, just take a path that doesn't activate them.
Right. And I think it's really simple. Like we do have this amazing central nervous system and brain and all of that it tells you when you're taking too much risk. I'm sure, Will, at some point when you were doing your stuff with Bitcoin, you were probably, waking up at night thinking, what the hell? You were obsessing about it, right? And then I'm sure when you were levering up your stocks during the global financial crisis, that did not feel comfortable. There was some part of you that told you, I don't want to do this. This is not a good idea. And so our central nervous systems are these highly tuned things that have kept us out of danger for a long time. And I don't think the idea of suppressing that or ignoring that, or you could do all the yoga and meditation you want, it's still there, right? And believe me, I'm the type of person, like I'm not the type of person that has racing thoughts through my head. I've been in my head for my entire life, and I have a lot of control over my thought processes. But even then, I still understand, like, I experience fear when, there's a lot of money potentially getting evaporated out of my portfolio. And so, like, it doesn't matter how zen I am about whatever, like, at the end of the day, when you're taking food out of my family's mouth, I'm going to panic, right? And that's what it feels like, when the market starts to move in a way that is not the way you hoped. And so I think that we have to understand our personal risk tolerances. And what I was trying to get at with the idea about, like, understanding our risk tolerance and it being more of a limbic thing rather than a neocortex thing, is that my issue is very often, or almost always, when you go to a brokerage, when you go work with an advisor, they're going to give you a questionnaire, right? And it's going to say, here's what, like, here's how I feel about this, or here's how I feel about that. I'm looking for this type of portfolio. And they're trying to gauge your risk tolerance. The problem with that is that when you're filling out this questionnaire, what part of your brain is being engaged, right? It's the neocortex. It has nothing to do with how you're actually going to experience risk. And in my opinion, like, ideally, like, when I kind of get my wealth management firm set up and all of that, my ideal would be to have a gamification way of doing it, where if I'm suggesting, XYZ portfolio to you, you would have an app you'd put on your phone, and you would go play this game that's a simulator, like a stock simulator thing, and it would have the same sort of return distribution, volatility, all of this stuff as what I'm suggesting to you, so that you can actually see, test drive it by playing the game and see, because our monkey brain needs to be engaged with this to see
or you could get them to watch a horror movie or play Doom or something, get them in an emotionally activated state.
Right. And so I think, there's this lie that we tell ourselves that, I want this portfolio.
The Doom investment management firm.
Right. But also the interesting thing is that our risk preferences change on the context, right? Like, depending on how you frame risk and the situation that you're in. Like, for example, I felt way more risk during this whole coronavirus thing than I did during the global financial crisis. And I think the reason why is because, to me, this was like a much more larger systemic thing where, like, all of society could potentially get ripped apart rather than just some banks go down. Don't get me wrong, global financial crisis was a big deal. Capitalism almost ended, but, it wasn't potentially like a virus that's going to wipe out all of humanity, right? And so I think that aspect to it matters. It's that you might have a given risk tolerance, but if certain variables change, that tolerance can change very drastically.
So basically, your point is that the human, every organism really, every organism with a brain has emotional overrides built in. And it's literally physically impossible to stop an emotional override, to stop the limbic system taking control at certain points. And overall, when there is massive risk and volatility and the brain is exposed to that, it will be triggered. No amount of mental hygiene, you can't wrest control back from the limbic system.
I think you can, given some time, right? Like, but in that moment, yeah, you're going to feel it. And so, don't get me wrong. Like, there was an idea that I think Ben had about not trading for at least a month, right? In terms of, like, sort of having a rule in place. If you can stick to that, I think that's brilliant, right? Like, that's a great way to calm that whole thing, in the sense that if you are experiencing...
That's also the same as what you said. You basically just need to step to the side, essentially avoid triggering the limbic system or avoid triggering the emotional overrides.
Right, but because the limbic system isn't going to stay kicked in the entire time, right? It's this thing that kicks in and then it subsides. In fact, that's exactly how volatility markets work, right? What happens is that it's like our heart rate. Your heart rate gets really elevated, but then eventually it reverts back to its normal sort of level, right? And so it's the same thing with our limbic system. It's the same thing with anything that there's this stress response. You can't be running on adrenaline 24/7. It just can't happen, because eventually your body just is like, okay, I'm done, right? Like, I can't do this anymore. So I think that if you can have the pausing of things, that helps a lot. And if you can stick to it, great. I think the better approach, in my opinion, is just to not put yourself in a position where you're taking so much risk that you have to have a rule that I can't do anything for a month, right? Like, that to me indicates that you're just taking too much risk for what you're actually comfortable with, if that makes sense. Now,
Okay, so we've got two answers there. Reduce your risk, but also take a pause.
Yes. Yeah. I think you can do both. Like, but the key is really, I think, inside your gut, deep inside your gut, you know what is your risk tolerance. And and you have to be aligned with that, no matter, how wonderful your portfolio manager is, and no matter how wonderful your system is, whatever, at the end of the day, you are going to experience some level of risk, and that has to align with what you're capable of taking as a human being.
And your point is that usually the way of measuring risk tolerance is done in a period of calm,
right,
where you're sitting in a waiting room with elevator music playing, when it should be after you've just watched, I don't know, the storming the beach scene from Saving Private Ryan or something.
Or even better, I think what would be better is tell me a story about a time when you felt really sick to your stomach about a bunch of risk that you took, right? And going back and re-experiencing that, because we as humans are capable of doing that, right? Like, we can go back to our post-traumatic stress and all of that, and re-experience these things. And why? Because they're useful tools, right? This is why we have nightmares. It's so that it's a way to simulate really bad things in an emotional way.
This is also the episodic future thinking point from our first interview with a psychologist, Tom.
Right. So
Yeah.
I think if you can draw upon those memories, and it's like, I'm getting this feeling in my stomach, like I did, when I was levered up on my stocks, or I'm getting this feeling like I'm trading like an idiot, like I was with Bitcoin, then that's a moment that you should be like, okay, I need to hit pause on this, or I need to go to cash right now and just sort of sort myself out, or not make any changes right now and sort myself out. And I think that those can be helpful tools in terms of like trigger points, right? And like I said, I think that experience is tremendously valuable. That's the thing that you can draw upon to make yourself a better investor, because you have to make those mistakes.
Yep. All right. So you've sidestepped the first question by saying we need to sidestep things. Let's see if we can get a response out of you for our last one.
Okay. Did I sidestep it?
That's fine.
You were good. I loved it.
Okay. I don't mean to sidestep. If I'm being evasive, then call me on my bullshit. I'll answer it more directly.
No. I liked it. I was just teasing you.
Okay.
So carrying on, you mentioned Rome briefly before. So the final question is, so human sacrifice is no longer common. It used to be a part of many cultures around the world and was banned, for example, in Rome in 97 BC. So what is something that we routinely do now, which will be looked upon in 2,000 years from now as highness?
I thought about this because I heard you ask this question before, and I would say eating meat. And by the way, I'm like, I love eating meat. I eat animals all the time. But having said that, am I happy about the conditions that they're raised in? And do I feel I have to eat meat? No, I don't. I enjoy it. Sadly, that's the way I am. And if I could eat like lab grown meat tomorrow that was available to me at a decent price, I would happily do it. Because I don't think that's sort of the ideal thing for humans to be doing is raising, billions of animals to basically be our food.
To kill off in factories. Yeah.
Yeah, exactly. So I admire, like, my wife has a supplier, And the guy who runs this company is a remarkable human being in that he literally hunts all of the food, the protein that he feeds to his family. And this guy is like kind of remarkable in that he, here in downtown Toronto, was looking to get a falconry license so that he could get a falcon and like have it hunt like, game in the city. So you can potentially do this apparently, like, in an urban center, go get a falcon and train it to go catch you raccoons and like this and that. Like the dude's hardcore and hunts with a bow and arrow and all of this stuff. And I was just like, that's nuts. But I admire the hell out of him because, I think that's fantastic. Like
he actually has the guts to kill an animal and eat it.
Right,
Most
exactly.
people, I remember I saw I did a work experience on a farm once. I nearly threw up, or at least I was repulsed by the farmer beheading a chicken and then having to pull the feathers out of it.
Right. I see. That doesn't bother me. Like I visited India and like the whole thing was we would go to the market and like that's how you buy a chicken. It's like you pick the chicken and they slash its throat open and throw it in the bucket and it's flapping around and all of that. I didn't have to clean it myself, but I don't have an issue with killing animals. We've done it for a long time. We're omnivores by our sort of nature, but the factory farming thing I think is problematic. And if I could not do that, not participate in that, that would be a good thing. I think 2,000 years down the road, yeah, for sure. I think we'll look back. Now, there's a big, sort of assumption in your question that we're going to be around in 2,000 years. I hope that's the case.
What will ETFs be like then?
Hopefully we're way beyond money and all that stuff by then. But one thing I was going to share, and your hygiene question kind of triggered it for me, was that one thing that makes me really optimistic about the future is my son is almost 3, and he's had to learn about the virus and all of that. And one of the things that I've been doing is kind of showing him all these videos on germs. We've just been trying to teach him to like wash his hands and the importance of that. And what's amazing to me is that in the span of like a few days, he became obsessed with watching all these YouTube videos, cartoons, teaching kids about germ theory and about the importance of washing hands and stuff. And what's staggering to me is that like in that span, this little human that's 3 years old, is almost 3 years old, has learned about germ theory, a thing that took our species millennia to figure out. And like it's incredible.
It was only 170 years ago that they discovered about washing your hands, and this was exactly. I think from Jim O'Shaughnessy's Infinite Loops podcast. That's where I first heard about this. This shocking idea that it's only been 170 years that we've known about the importance of washing hands.
And when you think about how like now you take that idea and now we have this communication network like YouTube, where now I can put that in a cartoon, make it easily understandable that a 3-year-old can understand something that previous to like 200 years ago, no other human understood. That's incredible. Right. And that's, I think, the power of the ability for us to change things very quickly as a species on this planet. The thing that really gets me excited is not AI. It's the fact that we have almost 8 billion brains on this planet. And if we actually allowed every one of those brains to come to its full potential, how many problems are we going to be able to solve? Right. And so, I was going to say to you guys that like, investing is this weird thing where we have to have this optimistic view of the future, or else why would we invest, right? Investing is inherently an optimistic activity, but while simultaneously understanding all the pitfalls and dangers on the way to arriving to that optimistic future. And that's a weird place to be. You have to kind of simultaneously hold this optimistic while understanding all the things that can go wrong. And to me, that actually is very much of like Eastern philosophy. in the sense that like my family, like I said, comes from India. My background is Sikhism. And there's literally like a concept within Sikh philosophy of Chardi Kala, which is having a positive outlook on life. And while at the same time toiling in the realities of our world, right? And maintaining that optimistic outlook and oneness with the universe and our creator and all of that. And not that I'm super religious. In fact, I'm pretty much an atheist. But what's interesting to me in Eastern philosophy is this idea of holding two things simultaneously in one's head that can be very, at first pass, paradoxical. And I think, you know, that's sort of like within Buddhism, within Hinduism, within Sikhism, there's this idea that we live in reality, but it's not really reality. There's this deeper reality to everything. And so, but the only way we can experience anything beyond this reality is to live in this physical body. So it's a weird paradox, right? Like we live in this falsehood that the challenge is to go past that to this deeper truth. And I think, you know, from a behavioral perspective, that's an interesting thing in terms of being able to have strong beliefs that are loosely held. And I think a successful investor is really good at that. And I've tried to cultivate that.
I've heard that phrase.
I don't know, it's just a saying within investing, but to me, it's something that I definitely resonates with me, because you know, you can kind of believe this narrative that you've come up with, especially I think value investors do this a lot, is that they believe in the company and there's this intrinsic value, and you know, you can just be plain out wrong about that. And you have to be willing to kind of change your thesis if you know, it's fundamentally wrong. But also understand, you know, there's a difference between being fundamentally wrong versus just this is the way that things are going, but ultimately I will be right. There's a faith aspect to value investing that to me is very religious in a lot of ways, and okay. you have to be deeply a believer in that to be successable.
I have seen. I feel that there are some cultish elements. Sometimes people might have. I don't want to bring up Warren Buffett too much because, frankly, I think there is a cult around him.
So yeah, like I think that that's an idea that I wanted to mention.